want to bring in Kevin Gordon. He is with Charles Schwab to talk a little bit more about the outlook, looking ahead for the markets in 2025. And Kevin, it's great to have you here.
Morning. Nice
on set. So you just recently published your 2025 outlook, and one of the big drivers, or one of the big factors, I should say, within that outlook was the incoming Trump administration and the policies there. How do you see that driving markets in the new year?
Yeah, so it's tough because, I mean, as you guys were mentioning, there's a pro-growth side of this, there's an anti-growth side of this. Pro-growth, you think about less stringent regulation, possibly, either an extension of the TCJA from 2017 or further corporate tax cuts from there. On the anti-growth side, you have everything from tariffs to more restrictive and aggressive immigration policy. So potentially they offset each other, but I think that the sequencing is pretty important here. And the discussion about taxes this morning in particular, it's really not something that can be tackled, number one, unilaterally, but number two, until sort of well into maybe 2026, because you have to wait until the end of 25 for the expiration, and then you have to go through, the entire sort of negotiation process between the White House and between the rest of Capitol Hill. So that aside, I think based on some of the policy posts we've gotten from Trump over the past couple of weeks, especially as it pertains to Mexico and Canada, probably seems that he wants to start tackling tariffs and immigration right away. So from our perspective, at least from a market volatility sense, that's probably more of the driver, and is probably why you can never compare two eras and say that they're going to be identical, but it's probably a reason that you can use 2018 to some extent as a playbook from a volatility standpoint. There was a significant amount of volatility that year, not as much in the first part of the year, because that 10% correction we had was more driven by the shortfall implosion, but probably what you started to see in the second half of the year, where you did have, at that time, a near bear market. Not to say we get the exact same thing this time, but when you look at the sector makeup and what was hit the most with cyclicals, bearing the brunt of that, that's probably more of a realistic scenario to at least get more familiar with, because this year has been, pretty great, at least at the index level.
Heading into that potential correction off the back of this policy, should investors be thinking about buying opportunities in any of those pullbacks?
Well, I think that from a breadth standpoint, where we're at right now, even though we've seen a little bit of a weakening over the past couple of weeks, where it's kind of back to that Mag 7 trade at the expense of the rest of the market, underlying breadth and overall breadth for the market has been relatively strong. So if you were using at least a year out time horizon and looking at the market and what returns tend to look like when you've got this solid of participation and this solid of breadth for not just the S&P, but now moving down the cap spectrum, it does bode well looking at least a year out. So it would argue, to answer your question, probably yes. However, if you continue to see the market make new all-time highs and get to these records while breadth was deteriorating, it would probably bring back a scenario that we saw in late 2021, where you did start to see that divergence, and of course we know that ended up leading to a bear market. So I think we're far from that at this point, but if that were to start to sort of be the picture that you saw heading into 25, especially with a lot more policy risk, not just from a tariff perspective, but I would argue maybe more importantly from an immigration and a labor policy perspective, then that would be a bit of a different story.
What do you expect? I guess, what is your assessment there, just in terms of when it comes to the labor market, when it comes to the promise here from the incoming Trump administration of mass deportations, lots of questions about what that ultimately is going to do and some of the underlying weakness maybe that will be exposed in the labor market. How big of a risk is that?
Well, a lot of this is hard to tell. From a timing standpoint, it's not as if you can carry out, I think logistically this is sort of a nightmare in terms of trying to get that many people out of the country if you were to go more towards the aggressive end of what he's been proposing. If you were to just do the math of taking those individuals out and look at the shock, not from even just an inflationary perspective, but also from a demand and a growth perspective, you get a pretty material hit to GDP. I mean, if you shave the labor force by 6 to 7, maybe upwards of 8%, GDP growth and labor force growth track each other really closely over time. So it's pretty plausible that you would get a severe negative reaction for overall GDP. And I think even on top of that, what has been the trend over the past 4 to 5 years is that we've just become more reliant on immigration in terms of the growth of our labor force. So the almost 100% of our labor force growth over the past 4 years has been foreign-born individuals, has not been domestic-born individuals. So I think that needs to be taken into account in understanding the potential hits that you do have to the rest of the economy, especially in the services economy, which we've become much more reliant on in the post-pandemic era. So that, to me, is a bigger risk. But I don't know how much of a growth risk it would be, even maybe in the first half or first 3 quarters of 2025, because if it's a slower rollout of individuals either being deported or if you're curbing immigration into the country, that takes time for it to sort of feed over into growth. So I could see a scenario where immigration policy is not necessarily the biggest growth risk for 25. Maybe it becomes a bigger risk for even 26 or 27.
Is that risk underpriced in the market then from your point of view? And should investors be positioning differently to hedge against that risk?
I think it's underpriced, but it's just not priced at all because we just don't know what the meat on the bones is. We just don't have really a precedent for that. So in many ways, and I've been a musician all my life, and I'm thinking of kind of sight reading going into 25. Sight reading being you've never seen a piece before, you're kind of playing it as you go along. That's basically, I think, what we're facing. Not as much from a tariff policy standpoint, because we have a little bit to work from in terms of the first Trump administration, but certainly from an immigration standpoint. I mean, these sort of levels that you're talking about, upwards of 8 to 9 million people, which is the estimates from Pew showing how many undocumented workers are in the labor force. That is something that we really haven't seen before in terms of the scale, the scope and scale that Trump has been proposing.
And Kevin, before we let you go, I just want to quickly talk about what we've seen in the Mag 7 and what it represents for next year. We've seen Tesla, the best performer of the past month, and NVIDIA, the biggest laggard of the group. What does that tell you about a rotation in tech heading into 2025?
So I think that as the chart kind of puts an exclamation point on this, the theme and part of our theme, which has been pretty much the case for all of 24, and we think this persists into 25, is number one, you're likely to continue to see these really aggressive rotations into and out of groups or sectors, whether it's the Mag 7 versus the other 493, whether it's tech and communication services at the expense of the rest of the market. But I think even within groups now you're starting to see this wider dispersion. I mean, the performance gap that you noted between Tesla and NVIDIA, even over the past month, it's amazing that you would look at just the group of the Mag 7 and see that it has spiked, but it's been almost disproportionately driven by one or two names. So I think that is probably a more important theme to keep in mind, especially because the biggest companies are not always the best performers. And year to date, you've seen that where NVIDIA, yes, still second best performer in the S&P, but Microsoft is in, I think, 205th place. So you've got a huge gap between two companies that are still called magnificent in terms of the group that they're in. And I don't cover the stocks, it's just looking at performance. But it's just looking at the idea that there are other opportunities out there, and that is sometimes exacerbated by some of these rotations that you tend to get, notably the one that we've seen over the past month.
Sounds like breadth matters, regardless of whether you're looking at 7 stocks or 500. Kevin, thank you as always. So appreciate you coming in.
Nice to see you guys.
Thank you so much.